Hi everybody, Thomas here. When you think about what it takes to be a successful investor, you might think that you need a range of sophisticated tools and systems, not to mention rocket scientist level smarts to decipher the ebbs and flows and idiosyncrasies of the market. The truth is really much different and simple enough that anybody can do it if they're willing to learn a few critically important principles. In this video, I'll outline 4 secrets of success that the best investors in the history of the market have perfected, and that are also available to regular investors just like you and me. A simple way to stop following the herd that are the millions of market investors is to create a list of stocks that you can check on a daily basis. It doesn't have to be a long list or even be broad enough to cover every segment of the market. It just needs to have enough stocks in it to give you a basis to work from. You can use your list to check stock charts for signals or news stories with information that could prompt the stock to reverse and start moving in a new direction, or that could give investors a new reason to keep pushing the stock in the direction that it's already been following. That way, instead of waiting for the rest of the market to jump on board, you'll be able to respond quickly to early indications that the timing for a new investment is right. You'll start leading the herd rather than following it. Putting together a watch list begs the obvious question: how am I supposed to decide what stocks to follow? This is a question that most of us really tend to make much harder than it needs to be. Peter Lynch, the well-known fund manager of the Fidelity Magellan Fund in the 1980s, and whose success with the fund made it the largest mutual fund in the world at the time, used a very simple approach that I've adopted to good effect. He just paid attention to the products and services that he made use of on a regular basis. Suppose, for example, that, like me, you prefer Pepsi-Cola over any other soft drink. That simple fact could be enough to make PepsiCo a company that would be worth putting into your list and to start a more in-depth evaluation for its investing potential. The reason that even a simple watch list is useful is that as the market ebbs and flows from broad highs to lows and back again, stocks in different industries will see their prices swing from extreme highs to extreme lows as well. For some, their movement may seem to follow the broader market's lead, while others may seem to follow their own path or even move directly opposite to it. That means that as long as you're diligent in checking your watch list regularly, you can be assured of finding opportunities to make trades on a reasonably consistent basis. It's a fact that most investors tend to ignore stocks that have been beaten down in price. It's much easier to believe a stock is going to go up when you can see the stock has already been going up in the recent past. So it's not really that surprising that not many investors spend time dealing with stocks at historically low levels. The simple fact, however, is that ignoring a stock just because it's been dropping is one of the easiest ways to miss out on big profit opportunities. Just like passing the clearance rack at the department store means you can miss finding great additions to your wardrobe at fantastic prices. Of course, the simple fact that a stock is trading at historical lows alone provides no guarantee the stock will increase in price at any point in the future. That's why some of the most famous value-oriented investors in the market, like Benjamin Graham, Warren Buffett, and Charlie Munger, pioneered methods for identifying stocks trading at bargain rate levels compared to the value of their business. Some of the data points that you and I have easy access to and that reflect the spirit of value-focused investing include dividends. Dividends are arguably the most effective method for a company to pass value back to its shareholders. Dividends can be paid quarterly or annually and act as a passive income source independent of a stock's actual price performance. Even in today's interest rate environment, dividends are a good way for investors to generate useful income. Many fundamentally solid dividend-paying stocks currently offer yields that compete very favorably with what you'll be able to see even from long-term interest-bearing bond offerings. They're also an excellent reference for a company's fundamental strength, since a company must have positive cash flow and positive profitability to maintain dividend distributions in the long term. Price-to-book ratio is the second one. You can think of a stock's book value as the per-share price a shareholder would receive if a publicly traded company closed its doors today. It's what is left after a company liquidates all of its debts and pays all other outstanding capital expenditures and obligations. I like to think of book value as an indication of a stock's intrinsic value, which for my purposes is what I believe is the minimum price a stock should be under normal conditions. The market traditionally inflates stock prices to multiples of its book value of 2 to 3 or even higher in many cases. A price to book ratio below its historical norms, or even better, below 1, is usually a good indication that there is latent, untapped value and growth potential in the stock's future. The third is free cash flow. Free cash flow is a reflection of a company's ongoing access to cash. It describes the cash a company is able to generate after its capital expenditures. High cash flow means a company can accelerate debt payments, increase dividends, and expand its business operations through acquisitions or research and development. It's also a strong indication of a company's ability to weather the inevitable storms of economic or industry downturns. A consistent increase in a company's free cash flow over time naturally implies the company should be able to continue to grow its business in the foreseeable future. Most of us tend to hold on to a stock for too long. That's because we fail to recognize the critical reversal points that inevitably come to every stock. No matter how long a stock has been going up, at some point it will reverse and begin to go down. This reality has led market technicians and analysts to spend an incredible amount of time, effort, and money developing tools that can help them recognize when one of these transition periods has begun. The irony is that all of these tools really can't identify a reversal until after it has already started. I think it's even more ironic that a truly disciplined, value-oriented approach to investing in the markets makes these tools largely irrelevant. The fact of the matter is that successful value investors don't rely on these tools at all. Since they focus on finding great companies trading at bargain prices, all they really need to do is to be willing to wait for the market to recognize what a bargain the stock is as well, and then give the stock enough time to develop a solid long-term trend that yields the profits they need. Another simple but really useful tool that most investors don't include to make sure they get out of a stock before the worst of a downward reversal in price starts is a stop loss. Put simply, a stop loss is a price below the price you buy a stock at. In the event the stock closes below the stop loss price, you'll automatically sell your shares back to the market to close the trade. It is the point where you believe the stock's upside potential no longer applies, at least for the time being. You'll take a loss, but if you apply a stop loss, you'll be able to get out of the stock before the loss becomes too painful to deal with. You'll keep most of the money you put into the trade and be able to redirect it into your next investment, hopefully with better results. Setting a stop loss with your broker is so easy that there is really no reason at all for them not to be included on every investment you make. Even better is that you can adjust the stop loss on stocks that increase in price with your broker. This is called a trailing stop loss, because as the stock goes up, the stop loss trails the stock's current price. It never goes back down, which means that if the stock reaches a high point and drops enough to trigger your stop loss, you'll sell the stock and preserve a healthy portion of the gains you've been able to build, while still ensuring you get out before a potentially disastrous new decline in price really starts to gain bearish momentum. There is a common investing adage that says, treat your investments like a hobby, and they will pay you like a hobby. It may sound obvious to say that you need to apply a business-like mindset to every investment you make, but the fact is that too many investors, especially beginners, seem to treat their investments like a trip to the racetrack. When you think about it, it's actually ironic to hear the horror stories so many people tell about their half-hearted roll-of-the-dice attempts to make money in the stock market. Here's why. Suppose you're a store owner. In order to keep your store stocked with products your customers are going to find useful, you need to pay attention to their buying patterns. What products do they buy the most of, and what products tend to sit on your shelves the longest? You'll naturally want to make sure that your inventory reflects the buying attitudes and habits of your customers while also offering an attractive range of choices. Doing this requires daily attention as well as the need to plan ahead, not only for the products you're going to bring into your store, but also how you plan to clear them off of your shelves. Since you know that not all of your products are going to move as quickly as others, or even at all, you need to have a clear plan in mind for how you will deal with those less popular items. Your investments are really not all that different. I've already talked about a few things that you can equate to the planning stages of a successful business, like looking for solid companies that currently trade at deep discounts and using stop losses and trailing stops to minimize the risk of loss. Secret number 4 is a principle that simply cannot be overemphasized or ignored. How much of your hard-earned trading capital are you going to put into any single investment you make? The name of this principle is position sizing. Position sizing refers to deciding how much of your money you want to put into any single trade, which has a direct impact on how much risk you're really exposing yourself to in every trade you make. Larger position sizes leave you more exposed, while smaller position sizes give you the ability to minimize risk more effectively. It's also true that smaller position sizes mean that profits in winning trades won't be as large as they could be if you used more capital. But remember that the expectation you should work with is that you're going to have more losing trades than winning ones. That means that the more conservative your approach to position sizing is, the better off you'll be. Because even if you have several losing trades in a row, your losses will be far more limited as a percentage of your total capital. It's also wise to be willing to adjust your position sizing rules depending on your view of current market conditions. In my own Rebel income system, for example, my position sizing rule under normal market conditions limits my trading size to about 5% of my account's total trading capital. Over the last several years, and in the last 2 years in particular, I've lowered that number even more to between 2 and 3% of my total account in any single trade. A simple rule I've learned to remember is this: the name of the game is to stay in the game. If you run out of money because your trades were too big when the market turned against you, you won't be around to take advantage when it turns back in your favor. There's a big difference between the most successful investors in the stock market and those who simply hope to someday be able to achieve the financial success that will enable their dreams. The difference lies in the simple fact that successful investors have learned how to avoid making the same kinds of mistakes that everybody else continues to repeat again and again. I've given you 4 practical strategies for how to turn the most common mistakes that the average investor makes into strength in your own trading. If you'd like to learn more about my Rebel Income Value Investing System, check out this video. You can also click here to subscribe to this channel and get notifications for every new video I add. If you'd like to see my weekly trades, you can sign up for my trading alerts using the link in the description area of this video. Thanks for your time. I'm Thomas at Rebel Income. Talk to you again soon.